Started. Okay, from beginning and then presenter view. All right, so today's webinar is all about the credit score models that are changing in mortgage lending. Was anyone here aware that there is a change coming up? No? I see one head shake no, the rest may just be afraid to admit that they haven't heard about it. That's okay. Today we're going to cover everything we know now, and there's going to be some things I just don't have an answer to yet. Some things have not been fully finalized yet, so we're going to go through what we know now. Before I get into the topic, I want to introduce myself. So my name is Ivory. I own Insight Strategies. We're a credit education and credit repair agency located in Vancouver, Washington. Been around the industry about 15 years, from regulatory compliance to the lending space, dealing with pretty much every area in default, and now very much specialized in the credit side of things. So we provide credit repair, credit establishment planning, professional training, and webinars like this. And then we have an online credit education course as well. So today we're going to be going into the discussion of how the current credit score models are changing, how the new models function, and then how these changes are going to affect you in the lending space, and then the expected rollout dates of these changes so you know when this is all happening. And again, ask questions along the way, and then I'm going to provide you with all the information that's been released so far. Okay. And I'm going to open the chat real quick so I can see it if anybody has a question. All right. Okay, so before we get into the changes, it's important to make sure we understand how credit scoring works now. So, as most of you know, credit scores are a numerical representation of a borrower's creditworthiness. So essentially, that's meant to assess how much risk a lender poses borrowing, letting a consumer borrow from them. So the higher the scores equal better loan terms, lower scores equal higher interest rates or potential denial. Understanding the weight of the credit scores is also crucial if you're in the lending space. And it's also very important for a consumer to understand as well, which most consumers just don't have a strong understanding of this. This picture you see here, and actually I'm going to turn on my pointer so you can see where I'm pointing, laser pointer. This picture right here is a snapshot of the foundational components that drive the current credit scoring model. The way the data is interpreted, so the way the data for the 30% of accounts owed or 35% of payment history is interpreted can vary from model to model. And we're going to look at those models here on the next slide. So in lending right now, what you are using to qualify a borrower for a mortgage is known as FICO Classic. So for Experian, that's Model 2. For TransUnion, that's Model 4. And for Equifax, that's Model 5. So lenders that are offering conforming loans, which are loans eligible for purchase by Freddie and Fannie, have been required to use this FICO Classic model. Traditional credit reports don't consider trended data, which is something we're going to be looking into here soon. And that can offer a misleading picture of risk. And we're going to see exactly why that is and why we're seeing these changes. So a little history. When I had mentioned on the last slide, there's different models. This represents all of the different FICO score models heavily used today. There's actually two types of scoring that aren't on this chart, and that's FICO 10 and FICO 10T. So something important for you to know is that the credit bureaus, Equifax, Experian, and TransUnion do not create the FICO credit score. Fair Isaac Corporation makes that FICO score, and that's what FICO stands for, is Fair Isaac Corporation. The bureaus are given these algorithms. Those algorithms are then housed on their internal servers, which allows them to not only create the credit reports, but provide those credit scores. And over time, the new models of the FICO algorithm are presented based on changes in consumer behavior. So that's why we have all of these models available today, as there's been changes in what determines risk. They've introduced new models that can more adequately interpret this.
Are the models just weighted?
Yeah, go ahead.
I was going to say, are the models all just weighted differently? Is that what separates like score 8 from score 10 and 10T? Or are there other factors that are coming in, like aside from what we see here?
So this baseline component is the same. It's the way the information is interpreted that's different. For example, in some of the newer model, like in my model 10, a paid collection no longer adversely impacts the score in the same way. There's time weighting differences as well. In newer models, like a late payment is less impactful after 2 years. Where in the old model, FICO Classic that you use in lending, it doesn't matter if a late payment happened 2 years ago or happened last week, it's going to impact the credit score just as severely. So it's the interpretation of that information that's changed over time. Does that answer your question?
Yeah, that totally answers it. Thank you.
Absolutely. Let's see. So in 2014, FHFA basically introduced the new requirements that we're going to discuss more today. These requirements were to essentially review the algorithm that's going to be used in lending, because there just was no actual review happening and no time frame to where they said we need to look at changing the credit score models that are used. So in 2018, they required that process to be put in place, where they're validating and approving the new credit score models. And what was proposed, excuse me, if I cough a little bit, I've been getting over a cold, so bear with me. So what was proposed was the approval of FICO 10T and Vantage Score 4.0. Okay. Okay. Bear with me. Goodness gracious. Okay. So the idea of proposing these two new models was they're supposed to be more accurate. And there's a lot more innovation in the creation of these models, and a lot more inclusion for the consumer base. So this was posed years ago, and we're just now finally seeing the transition into the usage of these new models. Okay, so let's look at that more. Now I mentioned Vantage Score in this last slide. I want to explain what Vantage Score is. Has everybody heard of a Vantage Score before? No? Okay. Has everybody heard of Credit Karma? Yes? Okay. That's a Vantage Score. So in 2006, the credit bureaus said, we want to own credit scoring. We don't want FICO owning credit scoring. So they banded together, even though they're their own private separate companies, and they said, let's create a credit score together, and we want to rival FICO. And that's when Vantage Score was born. So Vantage Score, created in 2006, interprets this data differently. So I have this chart here on purpose. I kind of cut it off here, but you get the main idea. I have this chart to show you the difference in the weightings, right? Payment history is 40% versus 35%. Credit utilization in FICO 8's 30, well, in FICO in general is 30% versus 23% in the Vantage Score, et cetera. So you're going to see very different scores. I'm sure you're all used to seeing that, right? Somebody comes to you, I'm a 700. No, you're a 620, right? It's an entirely different model. It functions in a very different way, and we'll look at some of those differences on the next slide. So with the creation of this model, the whole idea from the bureaus was we want to take over providing the credit scoring that's used in lending. Okay. So this creates a lot of consumer confusion, because now not only do we have a FICO credit score and a Vantage credit score, but we've got different models, right? In FICO, we've got 8, 2, 3, 6, 5, etc. In Vantage, we also have multiple models. We've got 3, 4, and 6. So this leads to a lot of confusion for consumers, and then also for those of us in finance as well, if you're not aware of this. So Vantage Score and FICO Score, here's some of the differences between the two. This is all a summary of where we are today in credit scoring. We have a FICO Score with many versions of the algorithm. And again, FICO Classic is the version that's used in the mortgage lending space right now. When it comes to personal loans, credit cards, auto loans, they may be using other algorithms. I'm going to keep going back and forth on these slides, but we see here there are industry-specific versions of the credit score. I'm not going to go into the details of how those are different for today's purpose, but they do function a bit differently. And the Vantage Score is largely not used in any area of lending. 95% of lending decisions are based on the FICO score until now. So I'll let you take a minute to read some of these differences here. And you may be wondering why I'm discussing these differences in the two score algorithms, or it may be obvious by now. But we're going to score changes now on the mortgage industry side. So going forward, and we'll talk about the rollout and what that rollout looks like, lenders are going to have to provide both the FICO 10T and the Vantage scores to Fannie and Freddie. So FICO Classic is now going to be a thing of the past, and it's been used for over 20 years. The score was created in 1989. The newest version of FICO 10T, is going to be incorporated. And in addition, lenders are now going to have the ability to use both the FICO and the Vantage scores to qualify borrowers. So let's take a look in more detail on how we got to this point. So in late 2020, Federal Housing and Finance Authority, again, FHFA, announced that the other credit scoring software, the new version of FICO and the competition Vantage score, were going to be evaluated. And now it just got approved, okay? So let's look at the differences from what you're used to now that we reviewed and what's going to happen here with the rollout. So these are some of the more impactful differences I want you to be aware of. So the impact of late payments is going to be more pronounced than it was with prior FICO score versions. So a new late payment is going to have a bigger detrimental impact on the credit score. So consumers who miss a payment are likely to see a more severe drop in their scores under FICO 10 compared to what they've seen today. And that's from all FICO versions, not just Classic. FICO 10 is also unique in that the way it looks at personal loans is very different. So if you've worked with our team, you may have heard us talk about consolidating credit card debt into a debt consolidation loan to help boost the score super fast. That may be a thing of the past in many scenarios. So you're actually going to be penalized in FICO 10 for personal loans, where traditionally you see that score bump from a personal loan. It's considered more high-risk debt for somebody who has trouble paying off debt. So the algorithm is essentially looking at it as a negative. And then let's see. There is a suggestion, and I need to talk to FICO about this more. The great news is we do have a liaison with FICO that we can communicate with to get a bit more clarity on this. But some of the information that's come out is slightly conflicting, saying certain consolidation loans for credit cards will be looked at favorably while others will not. So we need to find out the details there so we can more adequately advise consumers. Here's some good news outside of this bad news. So some silver lining, rental data is going to be included, and a lot of this credit building tools that exist, like Experian Boost, you may be familiar with, are now going to be pulled into these score models and going to help the credit scores a lot more. So you've got more options available to boost credit scores that you didn't have before. Collection accounts, they're going to be treated differently in a more favorable way for the consumer. Any questions about any of this so far? Okay, let's move on. Okay. Here's the biggest change, trended data. So the newer credit scores are both that Vantage 4.0 and the FICO 10T, the T stands for trended, are including trended data. So who here has used Rapid Rescore or Wayfinder? I'm sure everyone here has at least one point. Yeah, I saw Jason raise his hand. With trended data, we are now looking at consumer behavior over a 24-month period. That means we're averaging our spending or usage of credit cards over 24 months. So they want to look at and categorize consumers based on those behaviors to better assess risk. So somebody who is carrying balances long-term is going to be looked at very differently than somebody who is a transactor who uses their card to the maxes their card out every month and then pays it off, and maxes it out every month and pays it off. So there's some pros and cons to this. Today's model is more of a snapshot, right? If you pull your credit today and your credit cards are all maxed out, you're going to see your score be a lot lower. If you pay them all off and you do a rapid rescore, or your creditor has now reported your updated balance to 0 and you pull your score, you see your credit score shoot up, right? It's a big variance you can see from day to day. The idea of the new model is to eliminate this big variance or this volatility that can exist from that. So when I say the last 24 months, this means everything that a consumer is doing today, through the next 23 months, this month through the next 23, 24 months, is now going to be considered in that credit score that they have 2 years from now. So it's really impactful, really important to know that this is affecting consumers right now. Excuse me. Okay. So let's look at these new categories that have not existed previously. The transactor and the revolver. These are the new categories, right? I guess labels, if you want, for consumers. Now this slide, as you see, comes directly from TransUnion. So this is already what's being implemented in the FICO models. So with the trended data, the credit score is looking at, like I said, who carries the balances versus who pays them off. Okay. So why does that matter? If we look at these consumers, consumer A is somebody who's paying down credit card balances. Consumer B is somebody who steadily uses their credit cards, steadily maintains the balances. And consumer C is a balance builder. Over time, their balances are increasing. With today's credit scoring, standard credit scoring, they would be at a 675. So every single one of these consumers would have the same credit score. Okay. What's changing based on the way they interpret the data is some consumer A who's been paying their credit card debt off over time now would have a 750 credit score. So they're now being rewarded for the gradual pay down of their debts. That's very different than anything we've seen before. Somebody who's a steady user is going to be at a 680 with this new model. That means if they just went and paid everything off and you did a rapid rescore, you're not going to see this giant bump in their credit score, right? And then somebody who is increasing their debt over time, we're seeing it steadily build up, is going to have an even lower credit score than they would otherwise, because it's more risk, right? This person's taking on more debt and has the inability to pay it off. So the whole idea is to better assess risk across the consumer base. So makes sense to everyone so far? All right. Okay. Now there's more changes. Okay. We talked about how the models themselves are changing. And again, remember, this is true, this trended data for both the Vantage and the FICO. So how are we going to be using two different types of credit score algorithms in lending? That's probably the question on everybody's mind. There's going to be a new method of calculating the credit score used for the approval process. Okay, so bear with me. I'm going to do my best to explain all this. So I want you to tell me if how I'm explaining things makes absolutely no sense. So we're going to work together on this one. So when you pull a credit report today, you get a merged credit file, right? You see all three bureaus, Equifax, Experian, and TransUnion, show the accounts on the credit report, right? It's a tri-merge report. Instead of having a tri-merge report, you're now going to have a bi-merge report. So that's going to be completely different. The way this is going to roll out is going to be in phases. So beyond, we'll talk about that more in a minute, but beyond that, right now, when you look at the qualifying credit score for a consumer, you're looking at the median score of the three bureaus, right? Whatever score is in the middle between Equifax, Experian, and TransUnion. Okay. There's going to be a new method of calculating the credit score used for the approval outside of this current median score. And the reason why is because if there was no change made, the current score methodology could shift credit scores lower, resulting in an increased cost of mortgages to consumers or lack of people qualifying. So the current plan is to migrate to an average score rather than a median, an average score. And they decided this based on a bunch of research that they did on the methodologies. So they took data from all the mortgages that have been approved to try to determine what's going to be the most advantageous to approving more consumers. And then also reducing risk at the same time. So there's going to be a phased approach in introducing the change. And we're going to look at that on the next slide. And instead of having that tri-merge report, they're going to change to a bi-merge. You're still going to have the ability to see all 3 credit bureaus, but only 2 credit bureaus are actually going to be used in the calculation. From what I've seen, you get to decide the 2 bureaus. You don't get to change it later though. So just a heads up there. That's what we know so far. Could change, but this is what we know so far. And there's more to it than that, but I'm going to leave it a little bit high level for now. Well, let me get into it a little bit more. So they want to avoid recalibrating the pricing grids over and over and over. So as they phase into these new approaches, they're going to start by using the average first, the average credit scores first. And actually, I think I have this on the next slide. Yeah, we do. So here's the proposed rollout with the bi-merge. With the current FICO Classic score being used right now, so the phase number 1, keep the current FICO Classic the way it is. And we're going to start with the averaging the credit scores, right? So averaging the scores for each borrower and then using the lowest score of the 2 borrowers. And then once you transition to the FICO 10T and the Vantage 4.0 models, so once that switch to the new credit score algorithm takes place, you're going to be taking the average score for each borrower and then the average of those 2 scores. Make sense? Okay. So whole idea, advances in technology, like I've mentioned before, better assessment of risk, regulatory changes, and then by April 2025, all lenders have to adapt to the new guidelines. But again, all of this is starting actually Q4 this year. And the changes are meant to create a fair and accurate representation of borrowers' creditworthiness, okay? So what does this mean for home buyers? So the estimate is that it's going to expand approval rates by 5%. Some of that is because the Vantage score provides credit scores for borrowers who wouldn't otherwise have credit scores. So if you've ever had the issue where there is no credit score in FICO, the Vantage score is going to establish a score for those borrowers. Some people are going to receive higher credit scores in the newer models, and they may qualify for a mortgage when they wouldn't before. So what everybody cares about, the rollout. So fourth quarter this year, we're going to start seeing the transition take place as far as the credit score calculation. Now, as with every transition, this is the published timelines. We might not see things roll out as quickly as they say that they're all going to roll out, but we do know, at least at this time, everything is supposed to be fully transitioned by the end of 2025. So I'm sure as there are hiccups and bumps as we start to see the transitions take place, we will maybe see different timelines. Now, keep in mind, this is for Fannie and Freddie. So at the current moment in time, this is not impacting VA, FHA, USDA, your other loan types, which is interesting. But yeah, this is what we're seeing right now. So this is your timeline right here. As of now, this is the most recent release. As there's changes in the timeline, if you're on my email list, I can keep you updated on timeline changes. We get the updates from the credit bureaus, and then I'm signed up for the updates too for FHFA, but the bureaus are also rolling out all the updates too, because obviously their customers are those who buy credit scores from them. Okay. Benefits. That's a very weird title. These are the benefits. So those paying down credit card debt over time receive the biggest benefit, right? We know that that's the case. Credit building tools are going to have a way bigger impact. We use so many credit building tools for our clients, and we see massive impact on algorithms like FICO 8, but in the lending space, we don't get to see as big of an impact. So even though it may sound scary because things like rapid rescore aren't going to be as effective, the credit building tools can be extremely effective. So you're still going to have the same ability to cause big score boosts for your clients that need to see it when they're qualifying for lending. So getting things like your normal month-to-month bills added to your credit report, those are really going to help your clients, and you don't have to put it in against their debt to income ratio, right? So you still have a lot of options that are going to be available. If you need those tools as this rollout happens, just let us know. We'll give you all the access. And then another great benefit is any collection account under $100 is ignored. So if you have seen like those collections for Comcast or collections for like insurance, like Progressive, we see a lot of, any of those collections are going to be ignored. And then paid third-party collections are going to be ignored. So while you might not care about the collections for an approval, right? If they're small dollar collections, they impact the score. Now, in the future, they're not going to impact the score. So that's going to mean you're going to see a higher credit score for these paid third-party collections when they exist, and for any collections under $100. So there are some good things that are happening. Okay. Ooh. Any questions about any of this? The big rollout. This is what we know so far.
Yeah, Ivory, when will
Love
we
it.
start to see some of this in the news, and when will our clients start asking us about the rollout for new credit reporting?
You know what's crazy is it's been, if you Google it, it's everywhere. But because of, I don't know what's the world and the way it is today, you know, we're seeing things on the news more like aliens and like everything else. I don't think anybody's realized what's going on, which is the reason I decided to put on the webinar, because I thought everybody knew about this until I was talking to some of our partners. I was like, hey, are you ready for it? Everyone's like, what are you talking about? I only had one person that knew about it. So I was like, oh boy, we need to talk about this and make sure everybody knows what's going on. So if you do a quick Google search, you're going to find pages about it on Google. They're all saying more access to consumers. So I think there's not really fear coming from consumers. I think as loan officers, you have to be ready for it, because it's going to transition how you advise your clients. There's pros and cons to it. Don't let the cons overshadow the pros. It's going to give you a little bit more variability in how you use credit reports, which is great. And you're going to be able to qualify more borrowers who have less credit history. I think that's really impactful. You have those people that come to you that have 1 or 2 accounts or have nothing but closed accounts on their credit report. They're now going to be able to move forward very easily because of the Vantage score, where before you're like, oh gosh, okay, I need you to go open a credit card. Let's wait 30, 60 days before it shows up on the report. And, you know, that's going to be hopefully a thing of the past with this new transition. I think the bigger sticking point is going to be those people that constantly have high credit card debt who aren't paying it off monthly. Those people now we have easier solutions for. We don't anymore. So yeah, it's my 2 cents anyway.
Yeah, this is huge. And like my company, we just started, we just got the opportunity to do soft credit pulls. So we can't use that on the approval process, but we
Right.
can use that, however, on the front end for a pre-qualification. Like if someone was on the border, or if maybe they were just finishing up with you and they didn't really have it to make it all the way to the end, we could check what they would look like on our end too. But we can't use that for any approval or anything.
Yeah, I'm quite interested in seeing how they're actually planning on this rollout for the tri-merge to bi-merge. You know, they mention you get to see all three credit scores, all three, you know, all three scores with the three bureaus, but you're only using two of them to qualify. And what I'm curious on that they haven't quite elaborated on is, do you get to pick which two after you see the three credit scores? Or do you have to pick it before you can see the three credit scores? I know they've said that you won't be able to change it later when you repoll, but it's like, can I just pick the two highest and then go forward from there? So, and they're already talking about rolling that out in Q4. So, you know, either I've overlooked that information and haven't seen it, or they haven't published that part yet. So, I don't
That
know.
would be a big part.
Right? So, yeah. Oh, I missed all the chat. Oh, geez. I'm sorry. I'm horrible. Okay, let's see. Okay, balances every month. Did I answer your question, Jason, on the how it'll affect people to pay their balances off every month? Oh, you're muted.
Sorry, I think I missed it.
Okay, so people who pay their balances off every month are going to be impacted. Oh, let me go back. They're going to be considered a transactor,
Okay.
and they're, or wait, where are they? Revolver. Oh, nope, sorry, they're a revolver. They're going to be okay. They're going to be considered, they're going to benefit more than they would have, than they will on the current model.
Okay.
So on the current model, you know, if you time the poll the wrong way, you're like, oh shoot, your credit took a big hit. Oops, I kept going way too far. There we go. Got there eventually. Actually, we'll stay here. So they're actually going to see a higher score under the new option because it's averaging their behavior over 24 months, and it's seeing that they're paying things off. There's essentially more data points that are used now in this model than the old models. Okay, let's see. I don't know. The short answer is all I know right now. Oh, sorry. I'm answering a question in the chat. Oh, it's from you too, Jason. Sorry. So what was your, what exactly are you asking is, or do we know if it's going to roll out for?
You said the bi-merge is coming out simply for conventional products.
Mhm.
So in essence, if government loans don't follow suit, we would be doing what we currently do with the tri-merge for government loans. Conventional would be the new updated process with the bi-merge, and also adding in the Vantage score.
Yeah, so the Vantage score, the FICO 10T, none of that's rolled out right now for the other loan types. So
Wow.
this is just, I don't understand how they expect to have two opposing processes like this.
Right.
I mean, it's gonna, in one way, it may make more options for, I don't know.
Gonna turn into a nightmare though if you're flipping between conventional or
Mhm.
whatnot. And then also an idea. And I know we'll just have to wait to see how it rolls out, but we recently started doing soft polls as well.
Yeah.
So if we do a tri-merge soft poll, but then figure out what to do the hard poll.
Yeah, work the system.
Looking for that advantage.
Yeah, it's not a bad idea. Yeah, I mean, I wish I'm with how quickly they're planning at this point of rolling things out in Q4. I'm kind of curious if it's going to be, I'm guessing it's going to be a pretty soft rollout where they're like, oh, let's just kind of test this out and see if it really works, but we're going to give you the option to do things the old way too.
Not like the 203s to the Erlos, so it's like almost like boom, learn a whole new application.
Yeah. I mean, maybe they'll keep things the way they are on the front end, and when they sell the loans and they package the loans for sale, they're going to sell them with the new methodology. Okay, I had to mute myself that time. Any other questions or thoughts on any of this? It's kind of a lot to unpack. It's the first time we're really seeing a massive change like this in the lending space, especially when related to credit. So
What can you tell us about the pricing piece? I know that's extremely high level. I'm probably not even going to understand half of it, but I know that
No.
the company has this pricing engine called Mortec, and it's extremely
Yeah.
complicated.
Yeah.
So I wonder if like we would be like the last to get that.
All I can say is the only information I read about the pricing, and you know, I used to be in the pricing space a long time ago, and it just bored me to sleep when I was reading through it. And let me see, I gave myself a little notes on it. Let's see if I can find it. I don't know where it's at, but basically as far as the rollout goes, they're making it as simple as possible so they don't have to reintroduce pricing in the pricing engine over and over and over and over. And that's, I guess, the high level, what we can take from it high level, which I don't think really answers your question, but that's all I've got for you right now. I can send you the PDF that came from FHFA, which goes into that aspect as much as is publicly available. You can take a look at that.
Thank you.
Let me make a note of that to send that out. I'll send that out to everyone.
And this is recorded too, right?
Yeah, this is recorded. Okay. FHFA. Questions, thoughts from anyone else? Okay. We may end up having another session. It might just be more of a Q&A talk session as we get more details, just so I can keep everyone informed. But for now, this is what I know. And now it's time for me to shamelessly plug, but ask questions if you have them. It doesn't, you know, we can go back to our other topic. So here's my shameless plug. Okay. I own a credit repair company. You all are loan officers or in the real estate space. Many of you work with us. If you have questions, you have credit reports you want reviewed, especially as we start to see this transition take place. Like I said, as far as understanding the algorithms, that's where we specialize. I do have access to talk with the director of FICO. So if there's anything we're unclear on and it's something they're allowed to share, we can at least ask questions there on our end and make sure we get clarity. So as far as what we do, we're experts at removing negative information and then providing the reestablishment side, which is really just looking at how can we impact the algorithm in a positive way beyond what your capabilities are in the lending side. So far we've removed 17,000 negative items, a little over that, from our clients' reports. We're averaging about 6 to 8 months to get to the mid 7s, as long as our clients follow the reestablishment plan. That's my caveat while we're doing our work on the dispute side. We're in about 28 states right now currently. I haven't looked at that in a while. I might need to update that, but last I looked, about 28 states. And this year we've saved clients $728,000 in collections and charge-offs. So they did not have to pay a single cent. We were able to get that much removed from our clients' credit reports and help absolve them from owing those debts because of legal violations. Here's my other boasting, I suppose. We've removed 635 collections, 267 charge-offs, 908 inquiries, 123 defaulted student loans, and 216 accounts. We've had every single 8 mark on the account removed. And then we had some big score jumps. I'll let you take a look. And that's July. So there's some numbers from July. If you want to work with us, Jason raised your hand.
Yeah, just you finish up and then I'm gonna jump in.
What?
So go ahead and finish up and then I just wanna jump in at one point.
Oh, okay, sure. So if you end up wanting to work with us, we have a partnership portal. You can refer your clients through that portal. They get an email, tells them you referred them our way. We contact them within 24 hours, or they have access to our calendar to book time too. We send you progress updates along with the clients that explain exactly what's going on. It's not an automated email. It's actually written by one of our employees that shares what's going on. And And then we give you a lot of loan officer, real estate education along the way as well. Communication is really important to us. So that's kind of the foundation of what we do. And we're good at what we do. And I'll leave it at that, short and sweet. Go ahead, Jason, take it away.
Yeah, I just want to kind of echo what Ivory said, this personal experience. She is the sole person I refer credit repair clients to. She has done a phenomenal job helping my clients, helping my business, post more loans and so forth. So if you're currently not using her, and it helps that my office is 2 blocks away from her. So I should introduce myself, Jason Foster, Fairway Independent Mortgage, been on the street 6 years. And really have been a fan of Ivory, and it's been awesome to see her business grow. But definitely use her. She is by far the best that I've seen.
Thank you, Jason. Appreciate that. We're always trying to make sure we give you as many resources as possible, keep you updated on things like what's going on right now. So we can be more than just a credit repair partner, but really help accent everything you do as a loan officer related to credit. So, yeah. Any other thoughts or questions about anything we've discussed today, or any requests for future webinars? We do them every month. So if you're not on our email list yet, you will be because you registered. So, you know, now I've got your info. It's mine.
It's Jessica here at First Citizens. I wanted to say thank you for hosting this webinar because, you know, in my position with commercial banking and lending, it's most commonly asked where their credit score is and why can't they lend, or why can't we just put through an application? And so referring to you and knowing full-heartedly that you're going to educate these clients with your background and your expertise makes me feel all the more comfortable. So thank you for what you do and how you help my clients.
Oh, absolutely. Thank you. Very kind words today. Thank you, guys. Anyone have any thoughts, questions? It doesn't necessarily need to be on today's topic. If there's a burning question you've had about credit, we're here. Someone else probably has a question too. Might as well answer it. We've got technically 2 more minutes left.
Could you also send us the slide deck for the presentation?
Yeah, I can do that. I don't normally do that, so I'm absolutely happy to.
Thank you. And thanks for putting this on today.
Oh, sure. Of course. Of course. Okay. No thoughts, no recommendations for the next webinar topic. All right. We'll go back to our good old fashioned LO Q&As.
Can we do where Ivory hiked most recently as the next?
Where did I go most recently? Oh, I went to, okay, so I did a hike around Blue Lake most recently. Nobody's gonna know where that is. And the mosquitoes were horrible. So around St. Helens area, Jason, do you know where Blue Lake is?
Vaguely, yeah.
Yeah, so it's this beautiful blue lake full of mosquitoes and tons of jumping fish because of all the mosquitoes and bugs. But yeah, Justin and I always talk about my hiking, my hiking adventures. All right, well, I guess I can just let everyone go if nobody has any questions. No credit related topics or questions. All right, well, reach out to me if you have something you want to talk about offline. I will put my email in the chat to everybody. Let's see. Everyone in the meeting. Apparently, I don't know how to use chat. Don't hesitate to reach out to me if you want me to review a credit report. If you want to meet our team, we have a bilingual team as well. So if you have clients that speak Spanish, we can work with people that speak Spanish as well. So without further ado, thank you so much for joining us today. And hopefully I will see you guys with the next meeting next month.
Thanks, Ivory. See you then.
Thank you, Ivory.
See you. Okay, I will end the meeting now.
Thank you. Bye.
See ya. See ya at lunch this week.
Yes.
Tomorrow.